Turn your shares into a paycheck. Make your portfolio a side income stream. With covered calls earning $50,000 to $5,000 per month, even $10,000 with larger positions is possible. I'll guide you step by step from strikes to risk management. Here's the thing. We'll break down how the strategy works, how many shares you need per contract, how to pick strikes and expirations, and how to manage risk like a pro. I'll walk you through the income math, the real risks, and the rules I use so you can build a simple, repeatable process. Let's break it down. A covered call is when you own 100 shares of a stock and sell a call option against those shares. You collect a premium on day one. To clean outcomes, if the stock finishes at or below your strike at expiration, the option expires worthless, and you keep the premium, plus you still own the shares. If the stock rises above your strike, your shares are called away at the strike price. Your effective sale price is strike plus premium. What this really means is you're trading some upside for immediate cash flow and a disciplined exit price. What I mean by this is, the market pays you because you're giving up unlimited upside for a period of time. The more the market expects movement, higher implied volatility, the higher the premium you'll collect. Flip side, higher volatility also means a higher chance you'll be assigned and miss a big rally. Your job is to price the trade. Choose strikes and expirations where the premium fairly compensates you for capping upside and for assignment risk. Covered calls let you earn cash from stagnant holdings or from positions you hesitate to sell because you're hoping for a rebound. If you at least own 100 shares, sell a call above today's price and collect premium. If shares stay below the strike, you keep stock and income. Above it, you sell at the strike. Upside is capped, but you lower cost basis, adding discipline. You are simply making your stocks pay rent to stay in your portfolio, and until they are sold, you make money out of them. Let's take an example. Stock ABC trades at $100 and you own 100 shares. You sell a 1-month $105 call for $2. You get $200 up front. Your effective sale price, if called, is $107. $105 strike plus $2 premium. Your downside cushion is the premium, so your break-even at expiration on the combined position is $98, $100 minus $2. Here's how it plays out. If ABC ends above $105, you're assigned, you sell at $105 and keep the $2 premium, $700 total profit. If it ends between $100 and $105, the call expires. You keep the $200 and the shares, and you still have any stock gains up to $5. If it ends below $100, the call expires. You keep the $200, which offsets the first $2 of decline. At $95, you're down $300 overall, $500 stock plus $200 premium. What this is telling us is the premium softens the downside but doesn't remove it. The trade is built for income with a plan for exits, not crash protection. Why this example works. You chose a quality company you're happy to hold, picked a strike above price to target a disciplined sell level, and used 1 month to sit in the theta sweet spot where time decay helps you. If you want to aim for more income with the same shares, you can, but you'll take more risk. Another example. XYZ trades at $120 and you own 100 shares. You sell a 45-day, $130 call for $5.50. That's $550 up front, or 4.6% on your $12,000 of stock value for 45 days. If you could repeat similar terms, which is rarely possible, your effective sale price, if called, is $135.50. Your break-even at expiration is $114.50. Reality check. That fatter premium exists because the stock is jumpy. Earnings, a downgrade, or a sector surge could push through $130 fast, and you'll likely be assigned great realized income, but you might miss a moonshot beyond $135.50. Risk controls that actually matter. Size positions so assignment never hurts. Avoid selling calls right before earnings unless you're okay selling. Mind ex-dividend dates because early assignment can happen. Favor 20 to 35 delta strikes and 20 to 45 days to expiration as a starting framework. Use limit orders and liquid names to avoid slippage. And have rules. Take profits when the option loses 50 to 70% of its value. Roll if tested for a credit when you still want to keep shares, or let assignment happen when your target sale price is hit. Bottom line, covered calls let you get paid now, set a rational exit price, and add a small downside cushion while you hold stocks you believe in. Price the risk, pick your strikes with intent, and run the process consistently, and you can turn long-term holdings into a steady income engine. Let's read this screen like a trader. NVIDIA is around $179.74, and the strike ladder runs from $200 down to $135. We're focused on the $190 strike for a covered call expiring in about 26 days. Here's the thing. The closer your strike is to the current price, the higher the premium and the higher the chance of assignment. A $190 call is slightly out of the money, so you keep some upside before capping gains while still collecting a solid credit. Now profits and premium. The bid-ask on the $190 call is $4.90/$4.95. Use a limit at $4.90. One contract credits about $489.96 immediately. If NVIDIA finishes at or below $190, the option expires worthless. You keep $490 and keep your shares. If it finishes above $190, you'll likely be assigned and sell 100 shares at $190. What this really means is your effective sale price is $194.90, strike plus premium. With a cost basis near $179.74, max profit if called is roughly $190 minus $179.74 times 100 plus $490, approximately $1,516 in 26 days. That's getting paid to set a disciplined exit. You see short call, one contract, limit $4.90, with estimated credit $489.96. Use limit orders to avoid slippage, and make sure you actually own 100 shares per contract. Otherwise, you'd be selling a naked call, which is a very different, much riskier trade. About that PL graph. The mini chart describes the short call leg alone. A covered call is stock plus short call, so the combined payoff is different. What I mean by this? With a $190 covered call, your maximum profit is the stock's gain from your cost basis, per approximately $179.74, up to $190, plus the $4.90 premium, about $1,516. Downside remains normal stock risk, softened only by the $4.90 cushion. The premium reduces losses, but won't protect a big drop. Your break-even equals cost basis minus premium, per approximately $179.74 minus $4.90 equals $174.84. If the stock finishes above $190 and you're assigned, you sell at $190, keep the $490 premium, and your effective exit is $194.90. What is this telling us? Pick strikes that match your goal. Go higher, like $195 or $200 for more upside, less income. Go lower, like $180 or $175 for more income, higher assignment odds. Manage actively. Many traders buy back the call when it's up 50 to 70%, roll out, or up for a credit if price pressures the strike. Avoid selling calls right before earnings or ex-dividend unless they're fine with assignment. And always size so a sale at the strike is acceptable. Bottom line. This setup, $190 strike, $4.90 premium, converts your NVIDIA shares into a paycheck now and a rational sell target later. Price the risk, use limits, and run the process consistently.